Welcome to CRE Newsroom.
Today is 28th April 2026. In today's real estate and retail update, we will first break down the latest Deloitte London office crane survey, which reveals a record year for completions, but a looming supply gap as new construction starts plummet. Then we head to North London, where a massive acquisition of the Ashley House master plan signals a £1 billion bet on the future of alternative living in Tottenham Hale. And finally, a somber milestone for the British High Street, as Claire's shutters its final standalone stores, resulting in over 1,000 job losses and marking the end of an era for retail. From the cranes of the city to the storefronts of our local centers, here is what's moving the market today. Today, we are examining the findings of the latest Deloitte London office crane survey. In central London, the number of cranes over office construction sites is still being used as a rough barometer of commercial real estate activity. The report, released this morning, suggests that while London recently saw a surge in completed projects, the pipeline for the end of the decade is tightening significantly. According to the report, 2025 was a landmark year for office completions. A total of 7.1 million square feet of new office space was delivered in central London. This represents an 8% increase compared to 2024 and marks the third highest annual volume in the survey's 30-year history. However, this high volume of delivery is largely the result of projects that were initiated several years ago finally reaching fruition. The survey's data for new starts, projects just beginning construction, paints a different picture for the future. In 2025, new office construction starts fell by 35%, totaling approximately 4.8 million square feet across 57 schemes. This is notably below the 5-year average of 6.5 million square feet.
Deloitte attributes this slowdown to several persistent challenges, including rising construction costs, financing uncertainty, and complex planning regulations. A defining characteristic of the current market is the dominance of refurbishments over new builds. Refurbishments accounted for 66% of all new volume starting in 2025. This trend is driven not only by sustainability requirements, but also by the need to manage development risk and provide the best-in-class flexible spaces that modern occupiers now demand. Perhaps the most critical takeaway for investors and occupiers is the forecast for the late 2020s. Deloitte's analysis points to a potential supply gap between 2027 and 2030. Because fewer schemes are breaking ground today, there may be a scarcity of high-quality prime office space in the coming years. This scarcity is already impacting rents. In the West End, for instance, prime rents hit £187 per square feet, as vacancy rates sit at just 1%. In summary, the London market is currently transitioning from a period of high delivery to a more selective development phase.
Before we move on to the next story, if you're finding this useful, please subscribe, like, and share this with someone else who follows the market. Your support really helps me continue producing these commercial real estate updates.
Co-living developer Reshape has exchanged contracts to buy the remaining parts of the former Ashley House master plan in Tottenham Hale, northeast London, from Notting Hill Genesis Strategic Asset Program. The Ashley House master plan was originally split across 2 adjacent sites next to Tottenham Hale's rail and underground station. One of those parcels has already been developed, while the second, now being acquired by Reshape, covers the outstanding sections of the scheme. Under the deal, Reshape expects the wider Ashley House site to deliver around 1,000 new homes, of which at least half will be dedicated to co-living, with the rest comprising social and affordable housing, residential for rent, and some commercial space. The existing planning consent on the site allows for homes for sale, but Reshape indicates it will submit a new planning application to align the scheme with its co-living and build-to-rent strategy.
For Notting Hill Genesis, the sale is part of its broader strategic asset management program, which focuses on selling non-core sites and reinvesting capital into social housing operations. By transferring the remaining Ashley House plots to a specialist private developer,
the housing association is effectively handing over the purely market-oriented elements of the master plan while retaining flexibility to work with registered providers on the social and affordable housing components. From a market perspective, the transaction underlines continued interest in large-scale mixed-use schemes in well-connected London suburbs, particularly where co-living and private rental formats can be layered on top of social housing volumes. Tottenham Hale already benefits from strong transport links into central London, as well as ongoing regeneration, and the expanded Ashley House site is expected to add to the area's housing capacity and commercial offer over the next few years.
Jewelry and accessories retailer Claire's is closing its remaining UK high street stores, marking the end of its standalone presence in Great Britain, after more than 30 years. As of Monday, April 27, and continuing through today, all 154 remaining standalone Claire's locations have ceased trading. Administrators from Kroll Advisory confirmed that this final wave of closures has resulted in more than 1,300 redundancies. While the standalone shops have shuttered, it is important to note that the company's 356 concessions, primarily located within larger retail partners like Asda, are currently expected to remain operational. The company's head office functions also remain unaffected at this stage, though the Claire's UK website has been suspended and is no longer accepting customer orders.
The collapse follows a turbulent period for the retailer's UK arm. The business entered administration in January 2026, marking its second insolvency process in less than a year. In August 2025, a rescue deal by Medela Capital saved 154 stores, but the company reportedly struggled during a difficult 2025 Christmas trading period. Rising operating costs, including increased national insurance contributions and high street business rates, were cited by owners as primary drivers for the brand's vulnerability. Additionally, intense competition from low-priced online competitors has significantly eroded the market share of traditional high street accessory brands.
The administration process remains ongoing. Kroll has indicated that while unsecured creditors, including many landlords and suppliers, are unlikely to be fully repaid, there is active interest in the brand's future. Discussions are reportedly taking place with an interested party regarding the possibility of taking on new leases for a selection of the former store sites. There are also reports of talks with French entrepreneur Julien Jarjura, who manages the brand in other European territories, regarding the long-term future of the Claire's name in the UK. For many, the closure of Claire's represents the end of a high street era, characterized by affordable fashion and specialized services like ear piercing. From a commercial perspective, it underscores the continued volatility of the mid-market retail sector and the shifting priorities of younger consumers who are increasingly moving toward digital-first shopping.
That's all for today's update. Thanks for watching, and I'll be back with more CRE and capital markets news in the next video.